Hi, this is Rob Hoxton. I'm glad you're here. Welcome and happy holidays. In today's webinar, Making Smart Moves in Today's Investment Environment, we're going to touch on some of the important issues that are on everyone's minds here as we approach the fiscal cliff. We're glad you're here and that you've taken time to join us. As the end of 2012 quickly approaches, we at HFI will be making adjustments to client portfolios. And we wanted to take this opportunity to review the HFI investment management philosophy so that there won't be any surprises. Planned portfolio changes are intended to respond to market and economic developments, as well as to harvest gains in taxable accounts before cap gains rates are set to rise on January 1st. For those of you who are interested in learning more about our investment approach, feel free to go on our website and download a copy of my ebook entitled Investing in Uncertain Times. It's downloadable from www.hfiwealth.com. We also have bound copies at both offices, a limited number, which if you want to drop by or give us a call, we'd be happy to send you as well. This webinar, which will last roughly 30 minutes, most people's lunch hour, will be made available via our website, again, www.hfiwealth.com, shortly after today's webinar conclusion. Without further ado, I would like to introduce our speaker today, Chris Dorsey. Chris is HFI's investment analyst and portfolio strategist. He's been with us since June of 2011. If you've tuned into any of our other webinars, you've no doubt heard him speak. He's an interesting success story here. He interned as a college student here at HFI from May through August of 2009. He's completed the first two levels of the CFA curriculum. He will take the level 3 in June of this year. That's an incredibly arduous process, and I'm proud of him for the work that he's done there. He has his Master's of Science in Finance with a concentration in investments from the University of Denver's Daniels College of Business, and a BA in Economics and a minor in Business from Virginia Tech University. So without further ado, I give you Chris Dorsey.
Thank you, Rob. I'd like to welcome everyone who is attending this webinar today. Hopefully the next 30 minutes will be informative and beneficial for you. I'd like to start with just going over some of the things we're going to talk about today. We'll start with a look back at the history of the market and the bull and bear cycles that we've experienced over the last 100+ years. We'll look at some of the major U.S. market indices and how they've performed over the last decade. We'll talk about how many advisors are attempting to deal with difficult markets, especially over the last couple of years, and how those strategies have worked. And finally, we'll offer HFI solution and how we're managing portfolios and handling this market environment. Questions are always welcome. You can feel free to call at any time or email, and we'll get back to you with answers to your questions. So let's go ahead and begin. This is a chart of the Dow Jones Industrial Average going back to 1896, and it shows both the structural bull markets, which are highlighted in green, as well as the structural bear markets, which are highlighted in pink. Now, over this time, the Dow has experienced 8 major structural markets, with each lasting an average of 14 years. And of course, it's much easier to grow your wealth during the structural bull markets, as most boats are lifted with a rising tide. However, since each structural market lasts an average of 14 years, it's just as important to be able to navigate those bear markets successfully and to grow your wealth and protect capital as well during those times. And as you can see, if you can see my mouse here, we're currently in a structural bear market and have been for the past 12+ years. So here's an example that illustrates the importance of being able to accrue wealth when the market is moving up, but also protecting those gains and not taking a significant hit when the market is moving down. So this is a chart of the Dow Jones Industrial Average going back to 2000, and you can see the major ups and downs that this index has had over the last 13 years. You can see the arrows indicating the ups and downs that it has had. So the return from 2000 to the present for this index, the Dow Jones, is 11.46%. Now, all the returns you'll see in this presentation are price returns, so they do not include dividends. So again, the Dow Jones Index over this time period is up 11.5%. Money market is up 30.5%. And to determine the money market return, we're using 13-week Treasury bill rates. So again, as you can see, money market is up over twice that of the Dow Jones Index over the last 13 years. So here's a similar chart of the S&P 500, also since 2000, and it shows the significant volatility, the ups and downs that we've experienced over that time period. So a buy and hold investor of the S&P 500 over the last 13 years would have actually lost over 6%. And again, if you'll see, money market is up 30.5%. So you can see that the market makes it very difficult for you to meet your financial goals, and simply investing in an index doesn't work. So can we be smarter about what we buy, but also how we buy it? So what are other advisors doing to deal with this type of market uncertainty, these difficult environments? What strategies are they using, and how are those performing? Well, a lot of wealth managers out there today still cling to the tenets of modern portfolio theory, which is a theory that has failed over the last decade, and it's based upon assumptions that investors simply do not adhere to in reality. Now, this strategy does not adapt to changes that occur in both the domestic and global financial markets. Now, the way the strategy works is that you take a risk profile test, you're assigned a number that reflects your overall risk appetite. An optimal portfolio mix is determined based on your risk appetite from the risk profile test. A mix of low-cost ETFs are selected to add exposure to each of the asset classes in your portfolio. And then once or twice a year, your portfolio is rebalanced. So at HFI, your investment strategy is based on your financial goals, not a risk quiz such as you see here. So let's take a look at the performance of a hypothetical portfolio that follows this passive strategy and uses the suggested funds and allocations that you see on this slide, and let's compare it to the performance of some of the other asset classes. So this is a pretty busy slide, but we're going to work through it. This is a quilt that compares the performance of several major asset classes on an annual basis, with the best performing asset class for each year at the top. The quilt goes from 2000 through the third quarter of 2012, and the last column on the right shows the average annualized return for each of these asset classes. And you can see from this quilt where the opportunity was in the market for any given year and how that leadership changes, and sometimes pretty significantly from year to year. So if we look at 2011, for example, the Dow was up 5.5% for the year, and the S&P was actually flat for the year. International equities were down anywhere from 15 to 20%. So you may have turned on your TV at some point during 2011, seen the return of the Dow at 5.5%, and asked, well, why don't I have this return? Well, you can see if you look at the 2011 column in this quilt that U.S. equities, which is the light blue box, were actually down as a whole 0.14%. Any exposure to international equities that you had last year would have acted as a significant drag on performance, as that asset class was down over 16% as a whole. But again, the point of this quote is to show you that leadership changes, conditions change from year to year, and you need to be able to adapt. So with such a following for the strategy that we saw on the previous slide, it must have produced excellent returns over this time period, right? Well, let's take a look. So the dark blue box is the strategic allocation for the strategy that you saw on the previous slide. And this is for a risk level 5 client, which is a moderate or balanced risk client. And this is a portfolio that's rebalanced once a year and holds the ETFs that were recommended on the previous slide. So in almost 13 years, strategic allocation has produced an average annualized return of 2.8%. Over that same time period, money market has produced an average annualized return of 2.11%. So this strategy has essentially produced money market returns over the last 13 years with significantly more risk and roller coaster returns that you see in the chart at the bottom. So this quote is proof that you simply just can't set it and forget it. Conditions change, and you need to be able to adapt to those changes. So just to reiterate a few points, modern portfolio theory is predicated upon academic observations that clients don't often adhere to in reality. And for 12 years, clients have received no return for any added risk with this strategy. And modern portfolio theory is hardly a means for achieving your financial goals. So we've identified some of the problems. It's tough market conditions, it's It's passive advisors with passive strategies, and it's outdated theories. So what's the solution to these issues? At HFI, we bring more to the table than just modern portfolio theory. We utilize tools and resources that allow us to tactically manage your portfolios. We have tools that act as risk barometers to assess the level of risk in the market at any given time. We look at upside potential versus downside risk. We use relative strength analysis tools to measure asset class leadership, leadership within an asset class, leadership within a peer group, and so on. And just as produce in the supermarket moves in and out of season, so too do asset classes and sectors. And our strategy is to objectively identify areas of the market that are in season and that provide the best opportunity for wealth accumulation. So we use a combination of fundamental and technical analysis. And while you can play a simple melody on the piano with only one hand, you can play much better music with both hands. And that's exactly what we're doing. We're playing the piano with both hands. So both are equally important, but the focus of this webinar, of course, is on the technical analysis, which drives our tactical strategy. So that's what we're going to focus on. The tools we use are rooted in the forces of supply and demand, and it ranks asset classes from strongest to weakest based on this premise. Our first step is to identify the asset classes where demand is clearly in control. Our next step is to determine the areas within those top asset classes that are exhibiting the greatest strength. So for example, if domestic equities is the top-ranked asset class, our next step would be to identify the specific sectors within domestic equities that are leading the pack. So after determining the sectors displaying leadership qualities, we then evaluate several ETFs that provide exposure to the specific sector that you're looking at, and again, we select those that have the best relative strength characteristics. So our process essentially starts at the top and narrows down the investment universe to find the best stocks or ETFs within the best sectors and within the best broad asset classes. So on the next slide, we're going to look at an example of using a relative strength guided strategy to manage a portfolio. So here's an example of the relative strength concept in its simplest form. And this example looks at the RIDEX S&P 500 Equal Weight ETF, which is RSP, and the SPDR S&P 500 ETF, which is SPY. So this is the same 500 stocks in both of these ETFs, but with one index equal weighted and the other cap weighted. So the larger the company, the larger the weighting in that index. The chart on the left is simply a plot of the price of the RSP divided by the price of the SPY. It's using a scale of 3.25%. A green highlighted column indicates that the reading is decreasing and suggests outperformance of the denominator, which is SPY in this case, while a yellow highlighted column indicates that the reading is increasing and suggests outperformance of the numerator, which is RSP. So a green column means that you would want to hold the cap-weighted S&P 500, which again is favorable during large cap-driven market cycles, and a yellow column means that you would want to hold the equal weight S&P 500. So what we found is that there have only been 4 columns on this relative strength chart since 1994, which speaks to the long-term nature of relative strength. In the table to the bottom left is a relative strength switching comparison, and this looks at the performance of both the SPY and RSP individually, as well as the performance of implementing a relative strength to help guide your investment between these two funds. So as you can see, buying and holding either the SPY or the RSP since early 1994 has resulted in absolute positive performance. The SPY is up 208%, and the RSP is up 313% over those 18 years. However, if you were following the guidance of the relative strength chart that you see, you would have realized a return of more than 410%. So relative strength has been able to accurately identify the magnitude of movement between these two funds over a long period, 18 years, from January of 1994 through 2012. So to help further visualize the effect that implementing relative strength into your portfolio can have, even in the simplest sense, again, of equal weight versus cap weight, we consider the growth of 3 hypothetical $100,000 portfolios that started their investment in 1994. And that's in the chart you see on the right side. The red line represents an investment in the cap-weighted SPY since January of 1994 through the end of the 3rd quarter of this year. The blue line represents a portfolio that simply bought and held the equal weight RSP And finally, the green line, which provides consistent outperformance, as you can see, implements a column switching strategy based on the relative strength chart that we showed you on the left. So using relative strength to determine just whether to be cap-weighted or equal-weighted has resulted in an additional gain of nearly 100% compared to a buy and hold of either fund on their own over the past 18 years, which is pretty significant.
Chris, I feel compelled to jump in here and just give the old standard: past performance is no indication of future results. And this is complicated stuff, but it is interesting to see the impact of being able to measure relative strength and tilt a portfolio in the direction of that relative strength to the exclusion of relative weakness. So great job, but I did want to just say that our attorneys make us say past performance is no indication of future results. Thank you.
Thank you. So our tactical investment strategy allows us to be objective in our decision making. It allows us to remove emotion from the investment process, which study after study has shown significantly hurts performance. It allows us to adapt to changing market conditions, whatever they may be. It allows us to recognize high-risk obstacles and allows us to get more defensive when the time comes and protect precious capital. And ultimately, the end result is to make better investment decisions that tilt the odds of success in your favor. So removing emotion from the investment process is probably one of the most difficult things to do, especially these days. It's almost impossible to turn on the TV without hearing the words recession or fiscal cliff or something that makes you question whether or not you should even be in the market. So here you can see a few covers from the Economist magazine from August to October of 2011. Now, if I were looking at these magazine covers, of course, the last thing I would want to do is to be invested in the market. I'd probably have my money stuffed under a mattress. Well, in fact, when these magazine covers were coming out, that was the opportune time to be tiptoeing back into the market. As you can see from this chart, the market was forming a bottom at that time. Demand was starting to come back into the market. And from October 2011, the lows of that month, through the highs we reached in September just a couple of months ago, the S&P 500 had rallied over 30%. So the media's job is to sell, and fear sells, of course. However, magazine covers tend to be pretty decent contrarian indicators. So removing emotion. Being able to recognize and adapt to changing market conditions is essential in both protecting and growing your nest egg. So here's another quote similar to the one you saw on a previous slide, and it compares the performance of several major asset classes, and they're color-coded, so you have commodities, fixed income, foreign currency, domestic equities, international equities, and then you'll see money market again. So if we just take a look at equities, you see that in every year from 2003 to 2007, international equities outperformed domestic equities and is where you would have wanted to allocate more of your equity exposure. However, from 2008 through the third quarter of 2012, domestic equities have outperformed international equities in 4 of those last 5 years. And you would have wanted to tilt your equity exposure more towards domestic equities over that time period. So it's impossible to predict what the market is going to do and when it's going to do it, but by having an objective process, it allows us to adapt to whatever the market throws at us regardless of the reason. As the old market adage goes, markets can remain irrational much longer than you and I can remain solvent. So nobody can predict what the market's going to do, but by remaining objective and adapting to the changing conditions, you tilt the odds in your favor of success. Several of the indicators that we use alert us to increasing levels of risk in the market. So when the risk gets too high, whether it's in the market in general or just a particular asset class, it's important to recognize this and adjust the portfolio away from this higher risk area. So the table to the right is driven by relative strength, and it identifies the top 2 ranked asset classes at any given time. It suggests increasing or overweighting exposure to the top 2 asset classes that you're seeing in here. So if you'll notice, domestic equities was removed from this table on October 15th of 2007, which would have suggested reducing or underweighting exposure to this asset class. And it wasn't until September 4th of 2009 that domestic equities re-entered this table, which then would suggest increasing exposure and overweighting this asset class once again. So over the time period from October 15th, 2007 to September 4th of 2009, when domestic equities was underweight, as suggested by this table, the S&P 500 was down over 34%, as you can see in the table at the bottom. So again, it's the ability to objectively recognize when the risk is getting too high and then to adapt and reduce exposure to that high-risk area. And again, ultimately, our goal of our process and our strategy is to make better investment decisions. And I'd like to end with a thought from Bob Seawright. And he said, in all probabilistic fields, the best performers dwell on process. Now, this is true for great value investors, great poker players, and great athletes. A great hitter focuses on a good approach, his mechanics, being selective, and hitting the ball hard. And if he does that and maintains a good process, he will make out sometimes, even when he hits the ball hard, but the hits will take care of themselves nonetheless. So maintaining good process is really hard to do psychologically, emotionally, and organizationally, but is absolutely imperative for investment success. So again, it's impossible to predict what the market will do and when, but by having the tools and resources that allow us to objectively identify risk and opportunity, we attempt to tilt the odds in your favor and provide you with the best chance to increase your wealth and to meet your financial objectives. So that brings us to the end of the presentation. I'd like to thank all of you for attending. Again, I hope it was very informative and beneficial for you. We welcome your questions. And with that, I will pass it back to Rob for some closing remarks.
Thank you, Chris. Very well done. Chris, if you could advance to the last slide. We mentioned that we welcome questions. You can give your advisor a call or email, and you can see the information there on the screen. I think that what I took from Chris's explanation today were just a couple of key words: remain objective and adapt. It's so key, so important as investors that we remain objective, keep emotions in control, and then adapt based on empirical data. And that's what we're talking about. We will be making some adjustments in client portfolios over the coming weeks to both take advantage of opportunities as they unfold in this economic environment, to protect from risks that are present, and also to leverage this time of change in the tax code. So to some extent, we, in taxable accounts, will be harvesting some gains so that you can pay your taxes at the current low rates, which we likely will never see so low again. They are set to rise by about 8.5% federally on January 1st. So we'll be doing that. Again, we really appreciate your tuning in. This webinar will be available on our website in the next day or so. That's www.hfiwealth.com, and we appreciate your tuning in. We wish you a safe and happy holiday time frame, and look forward to seeing you very soon.